In this video, I'm going to tell you why you're stuck where you are. If you haven't raised at least $1 million or you haven't made at least $1 million, there's a very simple reason as to why you haven't. And by the end of the video, you're going to learn the simple steps that you need to apply for yourself so you can fix the things that are preventing you from getting to that next level. You know, when I crossed my first million and we crossed the first multi-million-dollar raises, on behalf of ourselves and other clients that we work with, there are several things that we had to keep track of and we had to fix. And by fixing everything that I'm going to go through this video, you'll be in a way better position, although it may be painful, to get to where you want to go. So the first thing that we have to fix and we have to look at is pretty much the ultimate thing is saying things that people want. For context, I used to be in an industry where we're focused on helping people raise money. It wasn't by fluke. The only reason why I wanted to help people raise money is because I wanted to start a business. And I wanted to find something that people wanted. But the only thing I could find that people wanted was to raise money. And I realized that if I can do this, and I can do it successfully, and I can show people how to do it successfully, then I can get money for helping people raise money. It's very simple. And so the only thing I noticed that people were flocking towards is when we found investors and funders that fit the criteria of the types of deals that we're looking for. And then a lot of people got in legal issues because they didn't really know how to do it. And so it's to connect them with proper lawyers that can help them structure what they were doing to prevent them from getting into any legal problems or any legal scares. And then that could help them raise capital successfully, properly, compliantly, and everything. So ultimately, the main reason why I went into capital raising is because people wanted capital raising. I just give people what they want. And when it comes to you and what you're doing, you have to really ask yourself, how many people have you actually spoken to that have said that they want to invest in your type of deal? Like, have you ever actually gone out and then spoken to people that said that they're interested in investing in the deal that you have? I mean, if you haven't, then that's the reason why you're not getting the type of success that you want. So ultimately, make sure you talk to people and they tell you that they want the thing that you're offering, whether it's the industry, whether it's the amount of money that they're going to make, whether it's the time frame they're going to make that money. Because if you just assume that people want the thing that you're giving out because you use AI, you use Google, you use all these things, but you don't actually do the hard work and go on a phone call with a real human being at the end of the other line and ask them, what exactly do they want? And you're going to find it, you're going to be very hard pressed to just get their pure opinion, because there are two types of research you can do. There's primary market research and there's secondary market research. Secondary market research is when you go to a book or you go to AI or you go to Google and then you read what you think people want and what people think people would want, what think investors would want. The primary market research is actually going up and calling the investors and asking them what they want. Ultimately, secondary market research is bound by a time delay. There's a time delay between primary market research and secondary market research because it takes time for people to report and get polled on what they think they want. It also, if you ask people if they would invest and they say yes, it doesn't really mean that much compared to if they do invest, because some people can say that they want to invest and then when it comes time for them to wire the funds, they may not actually wire the funds. So instead of looking for people to tell you what you want to hear, make sure that they actually take action and fund deals. The closest way is to look at the last time that an investor has recently funded a deal in the sector that you're looking at. And then if you do, then you'll be in a better position to get your deal funded. Whereas if you just find somebody that hasn't invested in your sector recently or in anything recently, then you may not know if they have dry powder or are relevant to your deal. So the ultimate way is to know how relevant somebody is to your deal, and then bring it back to the chance of you getting funded from that investor. So the relevance and the primary market research is the ultimate way to deal with the time variable in finding things that are most likely to work when you test things out. So test things out properly. in the sense of getting the people who are more recent and talk to people and do primary market research by giving people what they want. So the second thing is really you're not offering enough value. And value, all it is in a nutshell, value is just the benefits minus the risk of them getting what they want. So the benefits can be a function of the amount of money they'll make, the amount of, and money relates to, but let's just talk about money. There are different things that people can get, but the amount of money they'll make, the probability that they'll get that money, and the time frame they'll get that money, subtracted by the risk of them getting that money. So if you can get somebody like a certain amount of profit without, and obviously you want to add the risk, you can add perceived effort, because if you can guarantee somebody makes money without them doing any work, without them waiting any time, then obviously that's like the infinite, that's like the ultimate hack. But clearly, because we live in a world where there's waste and everything is inefficient to some extent, you're never going to find anything that perfect. So it's ideal and it's key to make sure that the investor, you do everything you can to make sure that the claims that you're making, bound by the law, based on what the lawyer reviews, has as little potential risk. And obviously legally you have to disclose all the risk, then you can't be too optimistic, and as little time frame in them making money. So that's the money. And then for them to have a certain benefit, because when you talk about making money, there are different ways through which they can make money that benefits them. One way is the capital appreciation of quote unquote making money. So some people make money by having the asset that they invest in go up in value, and they don't care about making cash flow. Some people just care about the value of the asset that they own going up, and they want to sell it later, or they just want to have their assets go up, because some people just want to own assets. They don't want to hold cash. Some people want to allocate their portfolios to a specific type of asset, like real estate or stocks or a certain industry of stocks, because the currencies are going down in value in many cases because of inflation. So some people don't care about making cash flows. People just want to make they want to own an asset. They want an asset to appreciate in value. Others want to make cash flow. Some people don't care about assets. Some people want to make cash flow. They want to make consistent cash flow over a certain period of time with high predictability. Others want something different. Others want the benefit of, capital preservation. So some people, they're not so interested in making money. They're more interested in protecting money. So protecting money is a form of making money, because otherwise they would lose the money. It's just making money at a lower risk profile and less aggressively. So how do they want to make money? Is it less aggressive? Is it more aggressive? And so these are the things to think about, and then you want to see those benefits, and you want to look at the risk. So there's obviously the risk of perceived failure. So that comes from risk, comes from the individual, and it comes from the project. So some people have their mandate of what they know they want to invest in, especially if they're a sophisticated investor, because many sophisticated investors know what they want to get into, but people who aren't sophisticated often don't. So those who are sophisticated have the wisdom to deal with the industry that they want to deal with. Those that aren't sophisticated don't have that wisdom, and then they just depend on trust and do their own research. So mandate is really, so what somebody's invested in, and they say that they wrote down that they're going to invest in, is their mandate. But what somebody says that they're going to, so that's what somebody's going to invest in. What somebody is not going to invest in is their, so you have the mandate, and after mandate, what somebody chooses not to invest in, is due to risk outside of their mandate. So if you as a sponsor, somebody who, for example, you don't have the levels of experience that they're looking for, there's something about you as a management team that doesn't hit the standards that they're looking for, then that could be a problem. If you as a sponsor don't have enough trust built with that investor, then there could be a perceived version of risk where somebody has to do more research, they don't trust you. If you are somebody who the people that the investor knows already have funded the deal that they're working on, or a deal that they're working on, or if they don't know you through a third party or second degree connection, then the perceived risk can go up. Look at FTX, the famous cryptocurrency exchange that crashed due to a scammer. Billions of dollars were lost. And even the Ontario Teachers Pension Fund in Canada, lost, I believe, almost 1% of their portfolio value because they invested in a fraudulent coin. Kevin O'Leary. You had Sequoia. Tons of companies invested billions in this company, and it failed because it was actually a real company. It wasn't a scam. It's just that the company, the founder took the money and misappropriated and threw it away illegally. It's like people invest to build basically a bank, and then the guy took the money out of the bank and used it to pay for political sponsorships, basically illegally, and donations. So the reason why so many smart people invested in a scam is because people were just following groupthink. They weren't thinking logically, they were following groupthink, and then they weren't looking and thinking things through logically. And because of that, that's why it went under. And because it went under, these are the issues that happen. And these are the things that are problematic. So don't do that. Make sure that you don't get into that position where you do that. So that's the third thing. And with that, essentially going back to square one, we find what people want and offer what people want in your deal or your company. And then two, offer value. So everybody wants value, but the way through which you offer the value may not be the vehicle that they're sold on, right? So that's what offering what people want, And then I guess three is like you should have a way of converting people. And when I say converting people, it's not like Christianity converting people or religion converting people. When I say converting people, I mean, you have to first get people interested. And then of the people you get interested, you have to get people to be sold. You have to know the difference between marketing and sales and fulfillment. Really, there are three functions. There's marketing, sales, and fulfillment. Marketing is getting people that don't know about you to know about you. Sales is getting the people that know about you to buy or invest into you. And then fulfillment is providing and fulfilling on the promises that you made and the service or product that you made to the person that you sold to, so that they get what they paid for. So those are the three levels of it. And each of these things have to not crush the investor or customer journey, because if they do, then that'll be a bottleneck in the business. And so some people build from the fulfillment side upwards. So some people focus on having a really good investment product or products, and they believe that if you build it first, they'll come. Others, unfortunately, are really good at marketing, and then they don't know how to fulfill. They're really good at talking about how something is great, but then they don't know how to actually fulfill. They're good at marketing and telling people about it, and they don't know how to actually offer the service. Some people are good at marketing, and they're not good at sales. So what ends up happening is some people can just market something and then they get people to invest, but they're not optimizing their investing because there's no sales process. But there's a really wise person called Naval Ravikant, you may have heard of. He's a mentor to Tim Ferriss, and another person called Tim Ferriss, and then the other person is called, forgive me, I'm just trying to get my thoughts. The other person is called, I believe, Outs or Mostly, yeah. So they both look up to Naval Ravikant, a multi-million-dollar investor. And one thing Naval Ravikant said, the reason why you're marketing is because you failed at sales. And the reason why you're selling is because you failed. Wait, I got that reversed. The reason why you're, the reason why you're marketing is because you failed. The reason why you're selling is because you failed at marketing. And the reason why you're marketing is because you failed at product. So if you have a product that's so good, you have an investment product, an opportunity that's so good, it's exactly what people need, and it is extremely valuable based on the value that we defined, then what will end up happening is it's so high quality that people will just come to it without anybody asking you. When you go to McDonald's, I hate McDonald's, but if you go to McDonald's or you go to a doctor, do you go because people told you about it, or because it's good, or because you watched an ad? Probably somebody told you about it. When you buy Apple, you buy it like the Apple computers. You buy it because you watched an ad, or because it's so good. So you follow where things that you trust. And so ultimately, if you have a good product, everything will work out. But because the world is inefficient, we have to do things in between. So we have to now market something so that people know about it. Because if we just depend on one, we can't get the other. But if you have no products, then in the long term you'll suffer. If you have no marketing, in the short term you'll suffer. So you have to have everything. This is it. Head to raises.com and learn more. I have more videos. Check them